What's up, everybody? Gen X Dividend Investor here. So if I told you that you could get more dividends with less volatility, would you be intrigued? Would you want to know about a lesser known asset that might offer more reliable income with higher yields than normal stocks? If so, then preferred shares might be your secret weapon, or they could be a hidden income trap. In this episode, I'll explain what preferred shares are, how they compare to stocks and bonds, their pros and cons, and whether they belong in a portfolio. I think you'll find this to be a very interesting video, as most folks don't seem to talk about preferred shares, so I'm pretty sure many of you will walk away from this having learned a bunch of new and useful information as dividend investors. I'll end things by sharing some fascinating data from a dividend expert who analyzed the average dividend growth rate of the S&P 500 from 1930 until now, and I'll compare that to inflation. So sit back, grab some Java, and let's get into it. Okay, most of us, myself included, usually focus on buying common stocks from dividend companies like J&J, Coca-Cola, or McDonald's. We usually get a share of their profits in the form of a dividend, often every quarter, for as long as their boards of directors vote to do so. Their dividends can go up or down, or even stop being paid depending on how things are going, though all the companies I just mentioned have historically only raised their dividend. But there's another income asset to be aware of called preferred shares, which are somewhat of a hybrid between stocks and bonds that you can choose to invest in. One big reason why some people invest in them is because they often have significantly higher dividend yields compared to common stocks or bonds of the same company. Like today, JP Chase, ticker JPM, is trading at $265 a share at a dividend yield of about 2.1%. But compare that to JPM.PR.D, one of their preferred shares. It's trading at 5.97% yield today. Of course, just because it's JPM and has a higher yield doesn't mean you should invest in it, and I'll tell you a bunch more information about them to be aware of. A helpful reference I often like to incorporate before I buy or sell something is Seeking Alpha, which I'm an affiliate of. I really value their articles on stocks, even if I don't always agree with the authors. For JPM.PR.D, we see the first author has it as a sell, and his article includes all his reasons. The next article talks about how stagflation could hurt it, and it has the ticker as hold. Another guy further down on the list of articles has it as a buy. I often like to peruse the articles as well as the comments other investors have, as I almost always glean new insights I didn't previously have, though again, nothing is guaranteed to be accurate. Anyway, companies issue preferred shares in order to raise money, rather than use traditional debt. Preferred shares are considered equities and often pay fixed dividends, like $1.50 per share over the course of a year or whatever, and preferred shares often have less price volatility than common stocks. That means their share price can go up or down, but usually not as much as normal stocks, which means most people usually aren't buying them for capital appreciation, but instead for their more reliable income, kinda like a bond. By fixed dividends, I mean their payouts are set contractually when they're issued to the public for purchase, and because they're fixed, it means they're seen as a more predictable flow of income. However, some preferred shares have what's called a floating dividend, which means the payout isn't fixed, it changes based on interest rates. So if rates go up, the dividend goes up too, and if rates drop, the dividend goes down. Those floating rate preferred shares can be a nice hedge when people expect rising interest rates. They're a bit less predictable than fixed, but can offer more upside in a rising rate environment. Anyway, preferred shares are traded on regular stock exchanges like the NASDAQ and the New York Stock Exchange. They have their own ticker symbols with a few quirks I'll show you shortly, and they typically trade less frequently than common stock, meaning they have lower trading volumes. One thing you might want to keep in mind with preferred shares is that the pricing can be a little less transparent than with common stocks. They don't always trade as often, so prices may not update in real time or reflect what you'd actually pay or get if you bought or sold. Like you might see a quote that says $25.30, but because of low trading volume, the real price you'd pay could be a bit higher or lower. It's not necessarily a big deal, but it's something to be aware of, especially if you're dealing with less popular or thinly traded preferred shares. One bad thing about preferreds is that since they generally pay out fixed dividends, that means that if the company hikes their normal dividend, then you don't get any of that. But a potentially nice thing is that if the company cuts or stops paying dividends to common stockholders, your preferred payouts might not be affected, at least at first. Of course, if the company is in serious financial trouble, it can suspend preferred dividends as well. And if that happens, it definitely means common stock dividends have already been suspended because preferred shareholders must be paid first as they get priority. Not only do they have priority over common stockholders in terms of being paid dividends, but they also have priority, aka seniority, if the company does something more drastic like declare bankruptcy. Seniority is just the order in which different types of investors get paid. Now, it's obviously not normal for S&P 500 companies to declare bankruptcy or to not have access to cash, so having priority in getting paid dividends isn't that big of a deal, but it's still good to know about. That being said, preferred shareholders aren't at the very front of the line for when someone needs to get paid. What I mean is that the line starts with creditors, like banks and bondholders, then comes preferred shareholders, and after them, at the end of the line are as common shareholders, who might get nothing, just like anyone else in the line. All that kind of explains why preferred dividends are seen as more stable even though they aren't guaranteed. Another thing to watch out for is credit risk, which is basically how financially strong a company is. And since preferred shares are a type of investment in a company, if the company runs into trouble, they might suspend dividend payouts or even struggle to pay back your preferred shares if they're called or liquidated, and I'll explain that in a moment. A way to check a credit rating for preferred stock, or bonds for that matter, is to look at agencies like Moody's or S&P. Lower rated companies might offer higher yields, but there's more risk they'll miss payments. It's worth noting that preferred shares typically carry a lower credit rating than the same company's senior bonds. This is because preferred shareholders are subordinate to bondholders in the capital structure during a bankruptcy or liquidation. As a result of that, preferred stock carries more credit risk than the company's bonds, even though issued by the same company. And to compensate for this higher risk, preferred stocks sometimes have higher yields than the issuer's bonds. Now, preferred shares are part of the company's equity, so issuing more increases the total number of shares outstanding. While issuing preferred shares doesn't dilute common shareholders' percentage ownership directly, since it doesn't increase the number of common shares outstanding, it does increase the company's obligations and can affect overall capital structure. If the preferreds are convertible, that may lead to dilution later, and I'll explain convertible in a bit. Now, a downside to preferred shares is that they usually don't have voting rights. That also means that preferred shares don't dilute ownership control in the same way common stock does. So why don't preferred shareholders get to vote? Well, preferred stock is designed to behave more like a fixed income investment, like a bond, than like a common stock, and there's often a trade-off between income and control that exists. More financial security means you're giving up voting rights. Common shareholders take on more risk with their lower priority for payouts, but they get a say in how the company is run, like voting for the board of directors. That means preferred stock is often issued to attract conservative investors who want reliable income, not influence or control. Those investors often care more about stable payments than about corporate governance. From the company's perspective, issuing preferred shares without voting rights allows them to raise capital without diluting control of the business. That aspect is kind of how some companies have different types of stock with voting rights. Like Meta has Class B common stock, which is primarily held by insiders, including Zuckerberg, where each share carries 10 votes and is not publicly traded. And I don't think that Meta has any preferred shares. Another example is Google, which I believe has 3 classes of stocks. Class A, ticker GOOGL, which are publicly traded shares with 1 vote per share. Class B shares held by insiders with 10 votes per share and are not publicly traded. And Class C shares, ticker GOOG, which are publicly traded shares with no voting rights. Google also does not have any preferred shares outstanding, though their charter authorizes up to 100 million shares of preferred stock, though none of which have been issued to date. Anyway, companies with a long history of paying dividends, like banks, utilities, and sometimes REITs, are all more likely to issue preferred shares since they often serve income-focused investors. But tech companies that are newer to paying dividends tend not to offer preferreds, as they usually prioritize growth and want to maintain more flexible capital structures and probably want more control. Bottom line, in portfolios, investors sometimes use preferred shares to generate steady income rather than to see capital appreciation, similar to how they use bonds and unlike common stocks. The price of preferred shares tends to stay closer to their original amount, which is usually $25 per share, so don't expect big gains like you might with common stock. Now, a downside to most preferred shares is that they can be callable, meaning the company can buy them back at a set price, like $25, after a certain date. That $25 amount is called its par value, which is kind of like its base or face value. That's the amount the company will base its dividend on. Not every preferred share is callable, but most are, so it's good to know any call date and terms before you invest. When it comes to preferred shares, you'll often hear the terms call and redemption, and while they're closely related, they essentially refer to the same outcome, the company buying back your shares, typically at the original issue price. So if someone says the company called their preferred shares, they're just saying the company decided to take them back because they were callable, so they pay you the set amount and you no longer own them. It's kind of like if you lend someone money with the agreement that they can pay you back early if they want to. If they do, that's the call, and you get your money back, simple as that. The price of preferred shares moves inversely with interest rates, just like bonds. So if interest rates go up, newer preferred shares will likely offer higher yields, which makes the older ones with lower payouts less attractive. That causes their price usually to drop. On the flip side, if interest rates fall, those older shares with better yields become more appealing and their prices can go up. If interest rates drop, your preferred shares might go up a few bucks in price, or however much. And while you're not in preferreds for big price gains, you could still lose a bit of upside if that happens. Most preferred shares end up getting called, especially when interest rates drop, because companies want to refinance at cheaper rates. It's not guaranteed, but historically, the majority do get redeemed once they become callable. Compared to common stock, preferred shares are usually less volatile, and hopefully now you're seeing how preferred shares are kind of like bonds, as they can provide a fairly predictable flow of income through fixed dividends. But unlike bonds, they represent ownership in a company, not a loan. Thus, bondholders aren't actually owners in a company, they're just acting as lenders, and they also don't get a vote. Common stockholders do get to vote, usually at 1 vote per share owned, and often around when the annual company meeting comes up. You vote for things like who should be on the board of directors, or maybe something to do with acquiring another company or stuff like that. So it's not like our normal democratic process of 1 vote per person, because if you own more than 50% of a company's shares, then you have control over the majority of the vote and you're said to have a controlling interest in the firm. Anyway, even if you can vote on company things, I read that less than 1/3 of common stock shareholders actually end up voting on corporate stuff, though institutional investors and those with tons of shares usually do end up voting. Okay, another key difference between bonds and preferred shares is how long they last. Bonds come with a set maturity date, like an expiration date, where the company promises to pay you back your full investment. So if you buy a 10-year bond, you know you'll get your money back in 10 years, assuming the company doesn't default. Preferred shares, on the other hand, don't usually have a maturity date, and those are called perpetual. That means you can technically hold them forever and keep collecting dividends unless the company decides to buy them back, aka call them back. So while bonds have a clear exit point, some preferred shares are more open-ended. That can be a good thing for income-focused investors, but it also means that you don't have a guaranteed payback date like you do with bonds. Companies like perpetual preferred shares because they don't have to repay the principal at some point in the future. Investors like them for the steady income from fixed dividends. Moving on, another key concept to know about with preferred shares is if they're cumulative or not. So if the company runs into financial trouble and can't make their payments, what happens next depends on whether the preferred shares are cumulative or non-cumulative. If the shares are cumulative, then any missed dividend payments aren't lost. The company still owes you that money, and they have to catch up on all missed dividends before they can pay anything to common shareholders. So even if the payments are delayed, you'll eventually get what you're owed, and that gives investors a bit more protection. On the other hand, if the shares are non-cumulative and the company skips a dividend, then you don't get it later. It's gone for good, and the company isn't required to make it up. So you're taking on more risks because missed payments won't be repaid. In short, cumulative preferred shares are safer in that sense. You can determine if a preferred share is cumulative or non-cumulative by reading the prospectus, maybe your brokerage, seeking alpha, the ticker, etc. Like let's say you search for preferred stock tickers for JPM and you find JPM-PRD or JPM.PRD or JPM.PR.D or whatever. It should also list its key features like the dividend rate, the callable date, and whether it's cumulative or non-cumulative. A common question you might have at this point is if preferred shares pay qualified or non-qualified divvies, and the answer is that preferred shares can pay qualified dividends, but you need to meet the holding period requirement, which is typically more than 60 days, to actually benefit from the lower tax rate. But some preferred shares issued by REITs or MLPs or foreign companies often pay non-qualified dividends, which are probably taxed at ordinary income rates like interest or wages. In that case, you're probably paying a higher tax rate, which makes them less ideal for taxable accounts, and perhaps retirement accounts are a better option to consider. That being said, if you're not in or near retirement, then I'd probably shy away from preferred shares. But some younger investors might choose to buy preferreds to balance risk or generate stable income in volatile markets. In tax advantage accounts, preferreds can provide tax-deferred income. So if you're building a diversified portfolio, a small allocation to preferreds still might make sense, even for younger investors. It all depends on you. Bottom line, younger folks generally should be focused on what enables the most long-term total returns, and historically it's been hard to beat the broad market ETFs like VTI or VU. Okay, now let's talk about convertible preferred shares, which are a bit more rare. These are preferred shares that come with an option to convert into common stock, usually at a fixed ratio, like 1 preferred share for 2 common shares. The idea is that if the company does really well and the company stock price goes up, you could convert your preferred shares into common shares and potentially make more money through capital gains. Now, a question some of you might be wondering is if there are ETFs of preferred shares, and the answer is yes. Some examples include iShares Preferred and Income Securities ETF, ticker PFF. Another is Invesco Preferred ETF, ticker PGX. I believe both of those tickers have trended down due to interest rates, which got uglier relative to where they were 15 years ago, along with they had some pushdown due to the financial crisis. Both ETFs have significant exposure to the financial sector, like banks and such. Some of their holdings may have lower credit quality, which can be more vulnerable during economic downturns, and all of that points to why investors demand higher yields for holding riskier securities, leading to price pressures on those ETFs. Plus, in times of market stress, investors may redeem shares of those ETFs, forcing them to sell underlying securities, potentially at unfavorable prices. This can exacerbate price declines, especially if the underlying preferred shares are not highly liquid. Okay, now let's talk more about how preferred shares are named, because I don't want you to be scared off by all the acronyms and letters you'll come across. They often have a combination of the company's name, a series designation, a dividend rate, and sometimes other special features. So its most basic form might look something like ABC Company Preferred. Then it also often includes the fixed dividend amount, so maybe ABC Core 6.5% preferred. Sometimes they might issue multiple preferred shares, perhaps at different interest rates or different dates that the company might buy them back, or cumulative versus non-cumulative, or convertible, or whatever. Preferred shares often have their own distinct ticker symbol, perhaps ending in a letter like PRA or .PRB or something like that. So Wells Fargo's preferred shares might be WFC.PRJ or WFC-J or whatever. Here's an example of a JPM preferred share, and it's JPM.PR.C-JP Morgan Chase & Co. 6 DEP NCM PFD EE. What a mouthful. That's what she said. Never mind. Okay, notice its price is near $25 a share, as most preferreds are. It starts with JPM, the standard stock ticker for JP Morgan Chase that issued it. The PR indicates it's a preferred stock, and sometimes they use just P. The .C is used as part of its ticker symbol to identify this preferred share series, while the EE is the official series that JP Morgan Chase gave to that specific preferred stock. The number 6 refers to the stated annual dividend rate of 6%. The dividend is typically based on the par value, which again is normally $25, which means a 6% dividend would be $1.50 per share per year, though remember it's usually paid out quarterly, so maybe 36 or 37 cents per share every 3-ish months. That also means that if its price is lower than $25 per share, then its starting dividend yield is higher, and if its share price is higher than $25, then its starting dividend yield becomes lower. Regardless, it still pays out $1.50 per share over the year. It just means that if you bought at that particular moment, then your yield on your investment would be that percentage, speaking just from a probable dividend payout perspective. Okay, and then DEP stands for depository shares, which is a very common structure for preferred shares issued by banks and financial institutions. It's also common to see the acronym SHS to be listed as depository shares. What that means is that instead of issuing a full preferred share, which might have a high par value like $1,000 or $10,000, they issue depository shares. Each depository share represents a fraction of a full preferred share, like 1/400th of a preferred share. This makes the preferred stock more accessible to individual investors by lowering the price and making it easier to trade. Of course, these days most brokerages let you buy partial shares, so it's not that big of a deal anymore. Then NCM stands for non-cumulative, which again means that if the company misses a dividend payment, they're not obligated to make that missed payment up in the future. Non-cumulative preferreds are inherently riskier than cumulative preferreds from an income investor's perspective, which is why their stated dividend yield might sometimes be higher. Next up in that ticker is PFD, which I believe is an abbreviation for preferred stock. And finally, as I already mentioned, EE is the series designator for that particular preferred stock. So in essence, JPM.PR.C, JP Morgan Chase & Co. 6 DEP NCM PFD-EE means you're looking at a depository share representing a fraction of a non-cumulative preferred stock series EE issued by JP Morgan Chase & Co., which carries a stated annual dividend rate of 6%. Now you might ask, why do they even include the 6% number in the name of it, since the actual yield can change daily based on stock price movement, and the answer is because it defines the fixed dividend dollar rate payment. Again, that stated rate, combined with a par value of 25, determines the actual dollar amount of the dividend payment, which is $1.50 per share per year, split into smaller quarterly payments, and $1.50 divided by 25 is 6%. So it's the amount the company is committed to paying, assuming they declare it, regardless of what the market price of the share is. Without that stated rate, you wouldn't know how much income you're actually getting to receive from the company. You can Google a company's preferred shares to get various ones they offer, and you can check places like Seeking Alpha for more details. Here's a quick search I did on Wells Fargo preferred shares, and you can see dividend rates ranging from 4.25% up to 8% with various types and special features. So with all that being said, should you invest? Everything has its own pros and cons, risks and issues, so you need to dive into the details and figure out if the investment makes sense for you. I obviously can't answer if you should invest without knowing more about you, your risk tolerances, your other investments, your cash flow, your job situation, your goals, timelines, portfolio needs, etc., etc. And regardless, I'm not a financial professional, I'm just someone who's passionate about good dividend stocks. What I can do is try to share my research, which of course can be wrong, so I'll always dive deeper to learn more and double check what us random YouTubers might say. Preferred shares can be a valuable tool for income investors, but you need to understand the risks, especially interest rate and call risk, and ultimately do your own homework. The lower interest rates are, the more attractive preferred shares often become, at least to me. I mean, when savings accounts and bonds are paying next to nothing, preferred shares can look better if they offer higher yields and more predictable income, depending on their other aspects. If you do invest, then I'd probably suggest only holding a small percentage of preferred shares in a well-diversified income portfolio. But I've never actually owned any preferred shares, so I'm still a noob when it comes to them. That all being said, don't forget that income tickers often underperform in bull markets. I mean, check out this total returns chart for that JPM preferred ticker I just talked about, and this highlights why I'd shy away from preferred shares unless you were needing income in retirement rather than focusing on total returns. This shows us that in the last 5+ years, JPM.PR.C has severely underperformed the bull market, as well as underperformed even more than normal common shares of JPM. Of course, you can also see how when the pandemic hit in 2020, it was actually doing better than the market. Thus, if you are more conservative and in retirement, then some amount of preferred shares may be compelling, assuming you're okay with all the nuances that might come with the shares in question. So what's your take on preferred shares? If you've invested in them, then I'd love to hear your thoughts and experience in my comments, and I'm sure other people would as well. If you've never owned any, but are now a bit more interested in them, then leave me a comment telling me that. And now I'll switch gears and I'll show you some fascinating data from a dividend expert who calculated the average dividend growth rate of the S&P 500 from 1930s until now, and I'll show you how your buying power would have increased relative to inflation over that time frame. Specifically, I'm talking about Howard Silverblatt, who's a senior analyst working at S&P Global. He recently estimated that, barring any unexpected market shifts, companies in the S&P 500 are on track to pay out roughly $635 billion in dividends this year. That's about a 7% increase from last year, outpacing the historical average annual dividend growth rate of 5.79% dating back to 1936. Put another way, over the past 90 years, the average S&P 500 company has raised its dividend by about 5.8% per year. Now compare that to inflation in the US, which has gone up by about 3.4 or 3.6% per year over the same time frame. That means your purchasing power from S&P 500 dividend income has grown faster than inflation by about 2.2% per year annualized. And to put that in more tangible terms, take a look at how $1,000 of income in 1936 could have grown until now, just from hikes, not from reinvesting anything. We can use the compound interest formula that looks like this. Future value equals present value times 1 plus the real growth rate to the number of years in question. So future value equals the purchasing power of the income after 88-ish years. Present value would be 1,000. Real growth rate is about 2.19%. The number of years is about 88 years because 2025 isn't over yet. And we get to $6,740. That means that if you'd received $1,000 of S&P 500 dividend income in 1936, and that income's real purchasing power grew at an average rate of 2.19% annually post-inflation, then its purchasing power in 2024 would be approximately $6,740. Or to say that differently, $1,000 worth of S&P 500 dividend income in 1936 would be able to buy roughly 6.74 times more goods and services in 2024 thanks to dividend hikes outpacing inflation. That's a ton for not reinvesting or doing anything. It highlights the significant impact of even a seemingly small positive real growth rate when compounded over a long period. It demonstrates how investing in assets that grow faster than inflation is crucial for preserving and increasing wealth over time. And again, that's not stock appreciation or reinvesting, it's just pure dividend growth. And just to be clear, if you had $1,000 in S&P 500 dividend income in 1935, and it grew at an average nominal rate of 5.79% annually, i.e. the dividend's actual growth rate before inflation, then that income would have grown to be about $133,000 in today's dollars. That $133K amount represents the actual dollar amount of income received, unadjusted for inflation. Hopefully all that makes sense. And even if it didn't, I still ask you to do me a favor and please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to do a shout out to my newest Patreon aristocrats, so thank you goes out to Mike E, who signed up for a full year, which gives him a discount. I'd also like to shout out DKRemVR, who also signed up for a full year. Moving on, and as a way to show my gratitude to people who leave really nice comments, I'm going to shout out 10 subscribers who've done just that. So thank yous go out to Tyrell Williams 1542, Joshua Gann 9279, Alan Davis 8675, Dogerman 11, who's left multiple nice ones over the years, Bitstream, who's also left multiple nice comments, Luke Small 6980, Connor Corbett, Sunny Skies 7544, who's left multiple nice comments and who spells their name kinda funky, then Hike Bike Home, who's left me multiple nice comments over time, and last but not least, JDH 1196. Now I'd like to recommend that folks check out my Seeking Alpha affiliate link, which has a sale running starting on June 11th for a few weeks, where premium memberships are $60 off, which I find to be a great deal. Next, I'd like to pitch my FastCrafts affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment even if they sign up for a full year. Also check out my Patreon page and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 85 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.